Thank you for joining me today. Lots to talk about, as there always seems to be in our business. You got to say this, if it wasn't for the emotional roller coaster up and down and Lord giveth, Lord taketh away kind of action that we face on a daily basis, it's definitely a fascinating business we're in. Never at a loss for learning something. I guess that's one of the main reasons don't have any plans to retire. I think this is a lot of fun. It's very interesting, keeps my mind working. And besides, I don't play golf. I do play tennis, but that only takes about an hour or so, as I've mentioned before. Well, I hope you all had a good week. Here it was a pretty good week weather-wise, except we had that smoke from Canada. It was very eerie. We had it here in Long Island. It was much worse in New York City, but for all the talk about how that was going to linger, the winds blew the other way, and it's been clear skies here. Speaking of good week and smoke and all that, let's talk about the stock market. Notwithstanding the smoke, the stock market did quite well again last week. We're up now 20% from the October 12th low. So I think it's a bull market. I think it confirms the position I've had that since late October, that the October 12th low was the end of the bear market, the beginning of a bull market. Again, I really thought that we might have made a low in June of last year when we got to 3,666. I like that number, but we did have a nice rally from the June 12th low, but June 16th low. But then August 16th is when the market started to worry about Jerome Powell's speech over at Jackson Hole. And sure enough, he came across very hawkish, and the market took a dive, retested its June 16th low, and by October 12th, we were just a couple of percentage points below that low. And so I think it was actually a successful retest. And here we've been bouncing back with higher lows and higher highs. Nevertheless, there's a lot of concerns about the narrowness of the bull market. To be exact, it was actually a fairly broad bull market from October 12th to about March 8th. Over that period, we did see the market rallying rather nicely with lots of sectors participating. But then March 8th, 9th, 10th, the banking crisis hit, financials took a hit, energy took a hit, and everybody seemed to say, okay, well, if we want to stay in the stock market, what's going to make it through this next stress test for the economy and for the financial system? And so the natural choice, as it was during the pandemic, was let's get into the mega cap 8. They have a lot of sales. They generate a lot of cash. I think they actually, even before the AI hype, they demonstrated that in order to get their stock price back up, they were willing to cut back employment, to cut back expenses, and they demonstrated that if they spend less money on all kinds of state-of-the-art technologies, the technologies they have right now generate a tremendous amount of profitability. And so I think that's what got everybody back into those stocks. And of course, the AI situation, which some view as hype, others view as real. We're more in the real camp, partly because we're biased. We've been talking about the roaring 2020s since the beginning of the 2020s, and that got waylaid by the pandemic. But we didn't give up on the concept, and now it looks as though we're back to seeing a technology revolution proceed that should be very good for the economy, for the equity markets. And my thinking on AI is that that is not the only technology out there that's revolutionary. There's also lots of revolutionary technologies in automation and robotics, nanotechnology. You put them all together, you integrate these things, and I think you have the technologies that can increase the productivity of the brain. Imagine that you can talk to your computer, HAL, H-A-L, from 2001, but HAL doesn't turn to be as malevolent as in that movie, but rather very useful. You just kind of ask it all sorts of questions, and it will provide you answers. And a lot of it is like, I can't remember when Greenspan gave that speech on irrational exuberance. I think you could even ask, Google or Siri this kind of question. And that's a very primitive version of AI, but you can definitely get an answer. I remain bullish, but I would like to see the market broaden out. I think it did broaden out last week. We saw the financials doing better, much better. We saw the industrials and materials doing better. And I think that's related to something that we showed everyone, as I think we were kind of first with it, showing that the construction put in place for manufacturing facilities was absolutely soaring. So that suggests that onshoring and infrastructure spending definitely is going to be a major stimulus to the economy. My daughter just graduated from Delaware. I'm kind of happy about that, timing-wise, because I don't think we're going to be able to get down there again for quite some time, for months, based on what just happened on I-95. A section of I-95 collapsed, and I guess it fell on a tank truck, or the tank truck exploded below it. But whatever, going north on 95, just that whole section was closed off. So I guess they're going to have to combine the lanes on the south section, so some of them go north. But it's going to be a traffic nightmare. But it just demonstrates the extent to which we need to really spend some money on infrastructure. So that's the way I kind of see things. One of my accounts just made me laugh, sent me an email in thinking about the CPI tomorrow, wondering whether Taylor Swift concert tickets might inflate the CPI number tomorrow. It's an interesting point, because some of these tickets, as he pointed out, are going out for gazillions of dollars to be able to sit behind the screen and not even see her. You can hear her, but you can't see her. And I think that's selling for like $2,500 a ticket. Fortunately, my daughter didn't put any pressure on me to take her to the Taylor Swift concerts. I have over the years taken her to a couple, but haven't seen these kind of prices for Taylor Swift tickets. So I'll be looking at the recreation and entertainment section of the CPI to see if there's any impact that the Taylor Swift tickets might have had on the CPI if things go awry tomorrow. And then, of course, we got the Fed meeting, and I think most of the bets are that they will skip, but they will say something to the effect that they just want to pause here just to get a real. I don't even know if they'll use the word pause. They'll just say, they've decided not to do anything at this meeting until they get more information on where things are headed, and imply that they might continue to raise interest rates. What will be particularly important to look at is the summary of economic projections that will come out. It comes out quarterly at these meetings. So this will be the June meeting, and the June meeting will have an updated SEP following up the March SEP. And it'll be interesting to see what they do with the Fed funds rate in the March SEP. And as in the December SEP, they predicted that the Fed funds rate would go up to 5.1% this year. And that seemed to be their signaling their terminal rate. Well, that's exactly where they are right now. And the question is, are they going to just forthrightly signal that they're not done and they have more to do? I think they should be done, given that there's lots of evidence that the tightening that's occurred so far has gotten into a restrictive area that will probably slow economic growth some and bring inflation down. I think inflation, anyways, was it will turn out to be more transitory than was widely perceived. It's certainly very transitory on the good side. Services is where it's been more persistent. But I still have this notion that the pandemic was a shock, and that there have been a lot of aftershocks. And one of the shocks was on the inflation front, and it's just going to take a while. But we are kind of normalizing, and I wouldn't rule out seeing inflation back under 2%. I know that's sort of a contrary view. It's widely perceived, I think, that maybe if we're lucky, inflation will come down to 3 to 4%, but it's going to stay stubbornly there. I think that's not the case, and it's partly because of my roaring 2020s idea that productivity is going to make a tremendous rebound as these technologies are implemented to deal with a fundamental chronic shortage of labor. Let's look at some of the charts that are related to my monologue here, and then we'll open it up for a little discussion with the Q&A. Okay, let's look here. This is the federal funds rate, up 500 basis points since March of last year. So it's a very aggressive increase in the federal funds rate, clearly. You'd have to go back to Volcker in late 70s, early 80s to see this kind of aggressive tightening. Of course, Volcker was super aggressive. He said, I don't control interest rates. The markets control interest rates. They'll go wherever they have to go to bring down inflation. And of course, that caused a recession, and it did bring down inflation. I'm not convinced that we have to go to that restrictive stance. And I do think that we are seeing some moderation here that the Fed has to take into account. But meanwhile, the financial futures markets do seem to be anticipating another 25 basis point increase, if not at the June meeting, then in the July meeting. And you can look at that chart when you have a chance, figure number 2. Now, here's something that I think kind of interesting. 4 economists at the San Francisco Fed put together a study, which we link for you in the morning briefing, on the effective federal funds rate. And basically, they take, it seems to me that they take a lot of interest rate spreads between the high yield and the 10-year, the mortgage rate and the 10-year, and kind of put that all in a pot and cook it and come up with this effective federal funds rate. I'm not sure that they directly account for quantitative tightening as a variable in and of itself. But certainly quantitative tightening has had an impact on spreads, particularly the mortgage spread, and that to some extent, therefore, is reflected in their effective federal funds rate. But I don't know if there's sort of a direct variable to quantify the banking crisis. Maybe it's those senior loan officers credit tightening surveys. They might be in there. You know what? I'll do a better job, and I'll see exactly what's in there, and I'll report that within the next couple of days, so we know what's what. But as you can see, the effective federal funds rate, according to their model, is more like 6% rather than 5%, as you can see in Figure 3. Then a sort of a closer view of it shows the QTs, the QEs, and the QTs. And here again, just a closer view of the effective federal funds rate. Clearly, it's been going up faster, and it's been above the actual federal funds rate. So, you know, we're already, 5.25 on the actual is turning out to be restrictive based on the weakness in the housing market, based on some slowing in maybe auto sales, based on the senior loan officers surveys. The well-in-6 is even more restrictive, obviously. Here's just the spread between the two. So I'll be monitoring those along with Melissa, who kind of brought this to my attention. So our inflation forecast remains the same. It hasn't come down. Inflation hasn't come down as rapidly as we were anticipating. But when you look at the PCED headline inflation rate, it was here between 6 and 7%. We thought that by the second half of the year of last year, it would be down to 4 to 5%. Took a little bit longer. We're in that range now. So we're still holding on to 3 to 4% for this year. And then beyond that, we think we could get down to 2.5, 3.5%, get there even closer. So transitory goods inflation, CPI, consumer goods has been quite transitory. Went up a lot, has come down a lot. We look at durables, we are back to deflation in durables on a CPI basis. Let me wet the whistle here. The non-durable goods, which is to a large extent energy and food, that's come down. So that's another example of the relatively transitory nature of goods inflation. Before we get to look at some of the services issues, this is kind of interesting. This is the ISM services prices paid index, and pushed ahead by 3 months. And you can see that it's a pretty good leading indicator of the overall CPI, which kind of makes sense since the overall CPI is got a large service component to it. What's really remarkable is how good the correlation is, even though the ISM services prices paid does not include rent, and rent is a big chunk of this thing. So who knows exactly why they track each other so closely, but they're clearly both in the same area of our interest, which is inflation. And the ISM services number suggests that by August, we could be looking at an inflation rate of 2%. I don't really buy that. I think it's going to take longer than that, but let's just watch it and see how that plays out. There's another similar relationship between the overall CPI again and between the NFIB small business survey, small business owners. And you can see here's the percent saying that they're raising prices, selling prices, and that, not surprisingly, is also pretty highly correlated, especially now. And that says that's with a 5-month lead time. And so by September, we should be down to 3%. I take that a little bit more seriously as a possibility than 2% by August. So 3% by September certainly would be consistent with our 3 to 4% forecast for inflation. Meanwhile, you can see we can monitor personal consumption inflation both in the CPI basis, which is 4.9%. The PCED is 4.4%. And interestingly, the PPI, which again does not, there is something called PPI personal consumption, and it does not include rent, obviously, as producer prices, and it's prices received by companies. And yet all these companies that do business with the consumers, they're reporting that their inflation rate is 2.7%. So there's some definitely encouraging signs that things are moderating, continuing to moderate. And not all of that necessarily has to do with tightening of monetary conditions. Rent inflation still high for primary residences at 7.3, and the owners occupied, of course, is still high on a year-over-year basis. But we've also taken to watching the 3-month annualized, and that definitely suggests that things are peaking right now. So maybe tomorrow we'll get a happy surprise that the rent inflation component has started to moderate and is taking some of the upward pressure off the CPI. Also, perhaps on the happy side, energy has been sort of flat to down, and that's brought the overall year-over-year inflation rate down into negative territory. Food has been a persistent one, but you can see that the food inflation rate has come down to 1.7%. So that suggests that the 3-month is kind of pull down the 1 year. I hope this is kind of helpful as you start to think about the CPI. So when we look at it tomorrow, you'll sort of just have a refresher course from what I just ran through. Well, there's always something to worry about, and that's the PCED core services ex housing. Powell a couple of months ago made a big deal about that. He said, look, we're making progress with consumer goods. We're making progress. We expect to be making progress with rent, but we got this persistent inflation problem with core services ex housing. And as you can see, it has been persistent in the PCED and the CPI. I don't know that they're exactly apples and apples. It's more like apples and oranges from a comparative standpoint. But the CPI services ex energy and shelter has a pretty distinctive peak, and it has been coming down. So we'll see how that plays out. So again, I hope that little refresher course and the inflation situation through April is useful, because tomorrow we're going to get May. And then we'll see on Wednesday how the Fed processes all that information. The staff is obviously going to scramble tomorrow morning to give them an analysis of the inflation numbers. And then I guess that during the meeting, the members, participants of the members of the voters, the participants are all the people that are either voters or non-voters. The participants will get to submit their forecasts for the Fed funds rate, for the consumption deflator, for GDP, the unemployment rate, and we'll be looking at it to see the extent to which they are trying to signal something by changing their numbers. Most importantly will be the Fed funds rate. The last number for this year was 5.1%. They may signal that there's more coming, or they're prepared to do more by raising that just a bit. Then the markets may, care about it or not care about it. We'll see how that plays out. But the markets certainly have been relatively carefree since October 12th. Well, let me turn now to some of your questions here. Put on my other glasses, more reading in nature. Kim has a question. Hi, I hear Dr. Ed Yardeni's bullishness on AI, but some of the stocks are trading at very high multiples. What metrics would investors be looking at, and what levels are indications that a stock is overpriced? That's a great question, and I appreciate the fact that you think I might have a concise, clear answer to that. I'm kind of working these things out just the way you all folks are all working it out. The AI revolution has kind of taken us all by storm, and the stock market certainly is reflecting that. But I think one of the conclusions that I'm coming to is that after trying to take down the mega cap 8 a few times, and we're definitely saying that there's something special about them. Maybe this is a contrary notion now that I'm saying there's something special about them. Maybe there isn't, but they are special companies. They are at the forefront of the technology revolution. They're not dot-coms generating a tremendous amount of cash flow, and they can be as profitable as they want just by cutting back some expenses. They know everything that's going on in the technology world that might turn out to be something that works and is very profitable for them. So they have a very high multiple, and I think the multiple got down to around 22 forward PE back in January, not too long ago. With the benefit of hindsight, that was a great buy at that point. And now they're back almost to 30. I think they got as high as 35, 36 back during the pandemic euphoria days, when there was euphoria about these particular stocks as being beneficiaries of the way to play the pandemic. Now the euphoria is about AI. But again, I don't think it's just AI. I think it's a lot of technologies that have really come together. Think about the technology. I was watching Air, the movie about the Nike's sneaker, the Air Jordan sneakers. And this was in the early 80s. And they had PCs there, they had telephones, and it was like, they had cell phones, but everything was like so primitive. And that evolved into the PC and software technology boom of the late 1990s, or the second half of the 90s. And when you think about it, it was a fairly limited technologies that were available. If you had the Selectric typewriters, a lot of people on Selectric typewriters, you could replace them with Word, and people could do their own typing. Then if you had a bunch of accountants doing Excel spreadsheets, you could replace that with doing spreadsheets by hand. You could replace that with Excel spreadsheets. But other than that, the technology revolution of the 1990s didn't really apply to too many other businesses. This one applies to all businesses. And again, my pitch, my thesis is that all companies are technology companies. The technology is there to increase their productivity and efficiency. If they don't use them, they're going to be left behind. So I think maybe, and again, this may be a jinx, but maybe we need to consider the possibility that in this world where the big mega cap 8 now account for 25, 26% of the S&P 500, maybe that's going to stay that way for quite some time. And that as a result, their high valuation multiples will continue to push the overall multiple of the market higher. As we all know, the S&P 500 forward PE bottomed at 15 back on October 12th. And the bear said, that's not low enough. It should be 8 to 10 before we'd even consider buying stocks. And I think they missed it as a result. And I think that they're not really incorporating the fact that the valuation multiple has been skewed up, biased up, use whatever word you want. But it certainly seems to be affected by the fact that there's a handful of stocks that are huge, have a lot of market cap, and have a very high valuation multiple. Do you have a view on the US dollar, Canadian dollar, and the euro? Don't have specific views on individual currencies, but I think overall, I think the dollar is going to surprise and not take a dive the way is widely been anticipated. The dollar tends to do well when the US economy is doing well relative to the rest of the world. And I think that's the case. The European data recently suggested that they fall into a mild recession. China's recovery from the pandemic has been weaker than widely anticipated. And so I think the dollar may actually remain relatively firm in that environment. So we'll be monitoring that. Bob, what do you think it will take for the Fed to reduce rates again? Will that require a recession, or will it be enough to see inflation drop to the 2% range, even if the growth rate is solid? Good question, Bob. Look, my thinking is that, as a general rule, you don't want to agree with the Fed because we all know they're always wrong. And so they're, to go along with their forecasts, you want to go the other way. But I've actually been betting that their forecast is correct, that they can, in fact, achieve a soft landing with inflation moderating. Now, if they listen to me, I'll give them an A+ for achieving not for the past, let's say, year of achieving what they wanted to achieve. They very aggressively wanted to get the Fed funds rate up to a restrictive level. They got it up to from 0 to 5.25%. I think that has achieved a restrictive level, which is what they said they want to do. And then they said once it gets to that restrictive level, in their ideal scenario, they would keep it there for a while and let that restrictive level gradually bring inflation back down. I think the mistake they could make is continue to be aggressive here, raising the Fed funds rate quarter, getting up to 6.25, exacerbating the underlying credit tightening that's occurring. And before you know it, we would have a recession. And in that scenario, they would then have to lower interest rates pretty aggressively, even if they haven't completely achieved their inflation target, or they would have to allow the recession to get worse because they're stalling and lowering interest rates. So, if they want a clean exit from all this, I think they got it. I think if they just leave the Fed funds rate here at 5.25% through the end of the year, maybe early next year, the bond yields kind of stays at a normal level of around 3.5%, maybe more. The mortgage spread narrows some. Inflation continues to moderate. I think they could be looking at lowering interest rates maybe sometime next year. I don't really have a problem with interest rates being a lot higher than they were during the zero interest rate environment. I'd like to see normal interest rates in a normal economy that's growing with low inflation, and I think that's actually a doable scenario. And the market so far seems to be anticipating something like that. Willem, how do you see the external drivers of U.S. economic performance in the short and medium term, especially demand for U.S. exports and external value of the dollar? Willem, I think you tend to be better informed about sort of the U.S. within the global context. I obviously pay a lot of attention to it. And my thinking is that the export side of the equation is going to is not going to be a major source of economic growth for the U.S. Maybe our agricultural exports remain strong, but Europe, I think, is looking kind of frail or stale or slow, whatever you want to call it. China's domestic demand looks kind of weak. I've been on a monthly basis recently, just the past couple of months, honestly, pointing out that China's imports have been absolutely flat for about a year and a half. That doesn't augur well for domestic demand. And then I don't know what to make of 1 month's drop in their exports, but a lot of people said that that's an indication that the global economy is weak relative to China's export machine. And that may very well be the case. So again, within the context of the dollar, I think to the extent that the US economy looks more dynamic, vibrant, stronger than the rest of the world, that tends to favor the dollar. And that in turn isn't rip-roaring exciting for exporters. Look, at the end of the day, I think a lot of it's going to depend on the consumer. And I know there's a story out there that excess savings are about to run out by the end of the year. So now maybe we'll have a recession next year, since we didn't have it this year. And the reason we didn't have it this year is because of excess savings. That's, I think, the new storyline from the naysayers. What I say is that if there's a $500 billion left of excess savings, that's chump change relative to some amazing savings that have been accumulated by the baby boomers, and that's $73 trillion of net worth, according to the Fed's flow of funds data. But I'll have more to say about that, and I've been writing about it. We'll write some more about it. I'll take one more question here because I've gone over the time limit. Are you worried about the ISM non-manufacturing index coming in lower than expected at 50.3 versus 52.4? Keep in mind that the ISM non-manufacturing includes construction, so that's kind of the way I don't lose any sleep over it. Is the construction may very well be weighing it down. I just don't get the sense, just by going to restaurants and airports and all that, that the service economy is slowing down, which is a good way to end this. Certainly, Taylor Swift tickets suggest that there's still plenty of demand for services with people paying thousands of dollars for Taylor Swift. But hopefully that's just an aberration. I hope that's not more of a macroeconomic indicator that I'm giving it credit for. But with that, let me thank you for tuning in, and let's do this again next week. Have a good week.